The Federal Reserve wants you to believe that 2026 will be calm, controlled, predictable, a smooth continuation of the so-called soft landing. They're signaling gentle rate cuts, careful data assessment, responsible stewardship. But what if they're wrong? What if behind the polished press conferences and carefully worded statements, the Fed is being pushed toward a decision that shocks the entire financial system? Not a small trim, not a minor adjustment, but something abrupt, something disruptive. Today, we're breaking down the three forces that could force the Fed's hand: a surprisingly hot economy, a political powder keg, and a technological shift that most people are barely paying attention to. And most importantly, what it means for your money. Let's start with the official story. After battling inflation for years, the Fed cut rates 3 times in late 2025. Then they paused, leaving rates around 3.5%. In early 2026, their language was cautious. Carefully assess incoming data, balance of risks, data dependent, translation, no drama, no surprises. The message is simple. Inflation is under control, recession avoided, soft landing achieved. It sounds comforting, it's reassuring, and it's dangerously incomplete. Because while the Fed projects calm, the underlying forces are anything but. Here's the first problem. The economy refuses to cool. The whole point of hiking rates was to slow demand and bring inflation back in line. But look around. Growth is still solid. The labor market remains resilient. Private investment, especially in AI and infrastructure, is booming. This is not an economy in retreat. And that's a problem. Because cutting rates into a strong economy is like pouring gasoline on embers. Inflation hasn't vanished. Headline numbers may be lower, but price pressures haven't disappeared from daily life. Groceries, housing, insurance, energy. If the Fed cuts too early and inflation resurges, credibility takes a hit. And credibility is everything for a central bank. So they're stuck. Cut and risk reigniting inflation. Hold and risk political backlash. Now add politics. Jerome Powell's term as Fed chair expires in May 2026. That alone introduces uncertainty. A new appointment could bring a different philosophy, a different tolerance for inflation, a different appetite for risk. But leadership isn't the only pressure. Fiscal policy matters. If government spending remains aggressive, you get policy conflict. The government injects demand. The Fed tries to restrict it. That's fiscal dominance. And it makes monetary policy harder. Independence is easy to talk about when stakes are low. It's harder when political pressure is intense. That's collision course number 2. So what happens when these forces collide? The soft landing narrative breaks. We're left with 2 potential shocks. Scenario 1, the shock cut. The Fed caves to pressure and cuts aggressively despite solid economic data. Markets rally hard. Stocks surge. It feels like relief, but it's a sugar high. Inflation creeps back. The dollar weakens. Cost of living rises again. And worst of all, the Fed loses credibility. Once markets believe policy can be influenced politically, trust erodes. Eventually, rates would have to rise again, triggering a deeper recession later. Short-term relief, long-term damage. Scenario 2, the shock hold, or even a hike. Markets are expecting cuts, so if the Fed holds steady longer than expected or hikes again, it's a shock. Stocks reprice. Bond yields jump. Mortgage rates stay elevated. Credit tightens. The dollar strengthens. Emerging markets feel immediate pressure. This wouldn't just be a US event. It would ripple globally. And in a fragile global environment, ripples can become waves. Now there's a deeper layer most people ignore. While everyone debates rate cuts, central banks worldwide are exploring digital currencies, including the Fed. A central bank digital currency or digital dollar. Officially, it's about efficiency, faster payments, modern infrastructure. But structurally, it changes the transmission of monetary policy. Instead of influencing banks, a central bank could theoretically influence individuals directly. Policy wouldn't just move through the system, it could move straight to you. Whether implemented soon or not, the architecture is being studied. And if introduced, it permanently changes the relationship between citizens and monetary authority. So step back. The Fed is trapped. A strong economy argues for patience. Political dynamics argue for stimulus. Inflation isn't fully gone. Global markets are fragile. The calm, predictable 2026 story is the polished version. The reality is that the system is primed for a shock. It could be a politically pressured cut, or a defiant hold that sends markets into correction. Either way, smooth sailing is unlikely. We're no longer operating under the old playbook, so prepare accordingly. What do you think? Will the Fed stay disciplined and risk a market backlash, or will it cut aggressively? Let me know your prediction in the comments. And if you want to stay ahead of these macro shifts, subscribe and turn on notifications. I'll see you in the next deep dive. Thanks for watching.